Hello, and welcome to our webinar, Act Now to Utilize the Current Estate and Gift Tax Exemption Before its Sunset. My name is Troy Farmer. I'm the Managing Director of Wealth Strategy and Planning here at Forvis Mazars Private Client. I am joined today by several of my private client colleagues that I'd like to introduce. First up, we have Sheila Christie. Sheila is a Director and Regional Wealth Strategist who resides in our Atlanta office. Faye Hilbert, who is also a Director and Regional Wealth Strategist who currently resides in our Raleigh, North Carolina office. And David Vogler, who is a Regional Industry Leader here in Private Client and a Partner in Tax. And David sits in our Greensboro, North Carolina office. So today we want to talk about the upcoming sunset of the gift and estate tax exemptions. And our agenda will be to go over some of the basics of this exemption, why you should consider to prepare now to use that exemption while it's available, hopefully how we can help you evaluate where you stand and provide further assistance, and then talk about next steps and an ideal timeline during this period. So with that, I am going to bring up here the first polling question, which is how many years has it been since you have done estate planning? Now, our polling questions today are designed strategically, I will say, to help reinforce some points that we are trying to make during this presentation. Again, it's probably never too early to start your estate planning, but there can be at times where it can be too late to take advantages and structure things the way you might want them to achieve your goals. So again, it's never too early to start, but right now in this environment, we do want to reinforce the point that now may be the time to act. And that is going to be the basis of the rest of our presentation today. So in a minute here, we'll pop up and see 45% in the last 5 years, which is higher than I thought and a good number. Some of you have never done planning. Some of it's been a while since you've looked at it. So hopefully today we can give you some tips and reasons why you might want to think about re-going and restarting that process now. But before we get into the exemption and how to plan around it, we're going to go back and cover a little bit of just a reminder of the overview of how the system works and what that exemption can do for you. So with that, I'm going to turn it over to David, and he is going to walk us through our first part of the agenda.
Thanks so much, Troy, and hello, everyone. We'll just jump right in. First, let's just talk about the estate tax. This is a tax on the transfer of property when you die. The inverse of that is the gift tax. That's a tax on the transfer of property while you're alive. And those two taxes work together for the IRS to make sure they're taxing you at every point that you've owned property, just making sure they've covered it all there. There's also a third tax that you may have heard of as the GST tax, but the generation skipping transfer tax. That's a tax that occurs on transfers more than one generation down. So think about that as maybe you're a grandparent and you make a gift down to your grandchildren. That skipped your kid's generation. That's what the IRS is trying to avoid there, because of course they want every generation to pay tax. So there's some planning that's done with that. It has similar exemptions and exclusions as the other taxes that sort of mirror those. But we'll talk about that a little bit more in a bit. So what is an estate? And just to put it simply, it's everything that you own. It's your property, your businesses, it's your trusts. If they have certain terms when you die, there are trusts that are included in your estate. But just think about it as everything. And because of that is why we need to really do some planning. It can get quite large here with this 40% tax rate that the IRS uses. It is a progressive tax system, meaning like your income tax, it uses brackets. But we get to that 40% pretty quickly. Once you are over the lifetime exemption amount, it only takes another $1 million to get you up to 40% of tax, which is quite early. So definitely want to plan for this. Let's look at what the exclusions and exemptions are right now. Right now, your annual exclusion is $18,000 to any person per year. And that could be multiple people. So if you want to make gifts to 5 people, each of those 5 people you can gift up to $18,000 to, and so on. It's not just $18,000 in total. So that is a great benefit. Can save you, if you're at the max rate, $7,200 in tax every time you do a gift like that. So a very important planning tool. Unlimited marital deductions. Between spouses, you can give as much as you would like between you and your spouse without running afoul of the estate and gift tax. Charitable gifts are also not included in the estate tax regime. So if you give money to a public charity, 501c3 organizations and such, that would not be included for the estate and gift tax. The amount right now in 2024 and will be inflation adjusted, we believe, for 2025 for the estate exemptions, $13.61 million. It's a combined tax because we're dealing, with all your property. So whatever you give now while you're alive and dead, the IRS combines that together and gives one person the $13.61 million right now. Your spouse also gets that. We'll talk about that as well, and some planning we can do with that. But let's go on to the next slide, just to give you a history of at least 25 years back of history, just to show you how small this was and where we've come from. Back in 2001, you can see that the amount was quite small that was excluded from your estate. I believe that was $675,000. So just think about how quickly you would get into a taxable situation. I can't even imagine for some families how hard that would have been. Think for people who don't want to get rid of their family businesses or their farms, how tough that would be to come up with liquidity, which is why we are needed to do a lot of planning. And luckily, Congress started helping with this over the years. You can see it steadily rising. In 2009, there was a big jump. And then 2010, you might see as blank. You may remember that as the George Steinbrenner year, we'll just say the Steinbrenner family year. There was no tax in 2010. So that family, the owners of the Yankees, were able to avoid tax. So a lot of times that's probably read that news. That was pretty interesting. But 1 year without a state tax, and then you have a pretty flat growth of the amount that is excluded on up to the big one in 2018 with the Trump tax cuts. And that's what we're dealing with right now, an increase for inflation over the years up to 2025, right around 13.6 million. I believe will be inflated, adjusted up to around 13.9 is what we're expecting. But after that, you see it drops off yet again to 2026 if there is nothing done in Congress with the sunsetting coming up. Speaking of the sunsetting, let's talk about that just briefly. That's going to happen at the end of 2025. Essentially, a lot of the different tax laws that were implemented in the Trump tax cuts get eliminated and are sunset at that date unless Congress extends them, which is why we really want everyone to understand and think about this from your estate tax perspective, because it can be a huge hit if you do no planning. But right now, as mentioned earlier, a married couple can transfer together $27.22 million free of taxes for estate purposes if you do some planning and really think about what you should be doing now and not defer, and Lord forbid anything happened to you and you didn't plan. And just to show you what that could be if you didn't plan, let's look down at this graph here. We're using a $50 million estate 2024 levels where we have this nice big 27.22 lifetime exemption. If you used all of it, the tax owed on what was left is around $9.1 million. If you did nothing and move into 2026 and you unfortunately passed away with no planning, we believe the exemption will be about cut in half. It will be adjusted for inflation, but say it's half of what it is now. Your taxable estate increases to $36.39 million, and that's a tax effect of a different, more tax that you pay of $5.4 million, quite a bit for doing nothing. And this doesn't take into effect what we have here in the third bullet, exponential benefit. Now, the whole point of estate planning is to take advantage of the time value of money. You're able to use these exemptions and place property out of your estate and let that grow in someone else's generation. And that value is out of your estate and could grow a lot. It could be a $5 million gift now. You choose the right assets, it could grow to $50 million, and that growth is outside of your state. So just very important to think about these things as we run into the end of 2025. And don't forget that your attorneys, your planners, they're getting booked up. And that's why it's so important to start now. We don't want to have any of the folks here on this call not be able to get an attorney hired to do this because they've waited until the end of 25 to plan. Troy, I'll kick it back over to you. I think we have another polling question.
We sure do, David. Thank you. The polling question here: have you connected your advisor team, wealth strategist, CPA, financial planner, attorney, evaluation professional, your life insurance agent professionals? Have you hooked all of your advisor team together so that they all know what your current estate or wealth plan is? So we'll give you a few minutes to answer that question. But again, what we're trying to reinforce here is it is very important that this team all work together. What we want to avoid is, say, your CPA or attorney working with you, making a change or an adjustment to your plan, helping you establish a plan that the other doesn't know about, and then, because one party's doing things over here and other party's doing things over there, things don't work out right. So here we're just trying to reinforce to you that we need to make sure that all of your advisors, and it does take a team of advisors, are all on the same page. And we got a pretty even split here of everyone working together. No, but we plan to connect, and not sure, but we prefer not to answer right now. So again, just trying to reinforce the point, as you'll see later, it is very important for all of your advisors to be on the same page. So with that, I am now going to turn things over to Faye, who is going to start us on what you should be considering and how we can begin to help establish that wealth strategy plan.
So the first thing we want to look at is documents, right? So these are documents that really everybody should have in place. So your last will and testament, and the other what we call ancillary documents. So those are going to be just those basic documents that say what you would want to happen if something were to happen to you either during life or after. So if you were to be incapacitated, who would make those decisions for you? We want to make sure all of that is in good order before we jump into any of the advanced planning. And a lot of this is going to be state law based. So based on what state you live in and where you hold your assets. Some states, almost everybody has a revocable trust. So that's a trust that you can change throughout your lifetime. If your situation changes, you just go in and amend and restate that document to make it fit your needs. And really to get it to best utilize that type of trust, you really want to fund it. So that's something that we see happen a lot is folks create a revocable trust, but then they never fund it. And so they may not get all the benefits of that revocable trust. Typically, when you do have a revocable trust, you're also going to have what we call a pour over will. So that will take care of any of those assets you don't get into the trust during lifetime, but those are really important to have in place, especially if you are, anticipating that you will be incapacitated, or if you own properties perhaps in multiple states. That's a way to easily get through not having to do probate in multiple states, which I've dealt with, and it's not fun. So we want to make things as simple as possible there for your heirs. And then when we do get to the advanced planning, this is really where we have a lot of fun. Right now, there are a ton of tools available to us that we as advanced planners can look at to fit. Really, it is your goals, your assets, what it is within the law that we can do, your net worth, and see what makes sense for you and your family. We look at cash flow planning in order to figure out which of these is going to be appropriate for you. Most of these are going to include what we call irrevocable trusts. So those are trusts that you cannot change after they are executed. We do try to build them and we are not the ones that draft it. Although several of us are attorneys, we do not draft these documents. We work with your attorney to get these done. But the drafting does matter, and we do want them to be as flexible as possible in order if there are changes down the road. But these are irrevocable. So we do want to make sure that they are in place the way we want them to be. And that takes some time to think through and really make sure that the terms are a match for you and your family long term. So when we look at these, we do have the most, is David was talking about, we have the most generous estate planning and gift tax laws that we've had in place for, in history. And so that does give us a lot of different ways to use these types of trusts. Perhaps, we're doing a larger gift to one of these trusts. And we might also, might be using these in conjunction with some of those simple tools, because we do always want to start with the simple tools first and then move to these. So with these, a lot of these are what we call estate tax freeze techniques. So what we are trying to accomplish is putting assets into those trusts and then letting those assets grow inside of the trust and outside of your estate. So that's called an estate tax freeze technique. So getting the value of the asset out and then letting it grow outside of the taxable estate. Another tool that we use, and this is a tool that's been under, the IRS doesn't love it. And so that's where we really have to make sure we cross our T's, dot our I's as we go through this process and get a qualified appraisal, is valuation discounts. So a lot of times when we're using these types of tools, we may be able to transfer an interest in a business. Perhaps it's not a full transfer. So when we go through the valuation process, there may be what are called discounts for lack of marketability, lack of control. So those are things that the valuation expert are going to look at, and we might be able to transfer some property that might be worth, in your mind, $1 million, but transfer it for maybe $700,000 on the estate tax return or on the gift tax return. And so being able to take advantage of that is really important. That is available to us now, and it might not be available to us down the road. Every year, whoever the current administration is releases what's called a green book and makes its wish list of tax items that might go through Congress. And so there have been proposals out there that would want to get rid of some of the valuation discounts. Also, another tool that we use now a lot is called a grantor trust. And a grantor trust is a trust that the grantor, after they give the assets away, continues to pay the income tax on, which is, normally the grantor goes, gosh, why would I want to do that? Why do I want to be the one paying the income tax? But the truth is somebody's going to be paying that income tax anyway, and that additional payment of tax is similar to giving an additional gift to that trust without having to file a gift tax return, and allows the assets within the trust to grow significantly without a tax burden. So it is a really, really important tool that we use, and we just that could go away at some point. Another thing we want to think about as we're doing irrevocable transfers is whether it makes sense to gift an asset or hold it in someone's estate during their lifetime. Because if it is actually in their estate when they pass away, you get what's called a step up in basis. And that step up in basis can be very, very valuable. So if you bought Apple stock for $10 a share and now it's worth 200 something, if you were to pass away holding that Apple stock, it is going to, after your passing, go to your heirs, and they are going to have a $220 basis in that stock. So if they go on to sell that stock, they are not going to pay income tax. However, if you were to sell it today, you would pay capital gains on that stock. So that is where we want to be thoughtful about the assets that are transferred whenever we're looking at this. So going through all of this, we want to be very thoughtful at each step of the process. And that's why we're encouraging clients to act sooner rather than later so that we have time to step through all of this. And with that, Sheila's going to give us an example.
Yeah, thanks, Faye. Up on what Faye was saying, we have multiple tools in the toolbox. Sometimes I like to think of it as arrows in our quiver. And if you look at these, you can see we also love acronyms. But a lot of these are, again, very defined tax trusts that we create a structure, and then you fill out what the meat of the trust is. You're still going to decide where things go, who they go to, when they go to them. But we like to put a tax structure around things so that it can have its best benefit to both your family and not to taxes. So thinking about some of the tools in our toolbox, one of the things that we work with a lot is, as Faye mentioned, an intentionally defective grantor trust. There's lots of flavors and variations of this. So for instance, a spousal lifetime access trust is a type of intentionally defective grantor trust. And this is where we like to work, planners like to work with the play between the income tax code and the estate tax code. So we can move assets out of the clients, out of your hand, and we can instead have them go into a trust. And that trust is for the heirs, that trust is for the beneficiaries. It is irrevocable. So again, these are some things that you want to make sure and be mindful about how you're going about doing them. On the income tax side, though, so for estate tax purposes, it's not included in your estate. However, for income tax purposes, we can still tax it to you. And you're like, why? Why would I want anybody to tax anything to me? And it's as Faye said, it has a dual reason. One is we can keep reducing your estate without using your annual exclusion, without using any more of your exemption. Paying those taxes on behalf of the trust keeps your estate down. And on the flip side, allows that trust and the assets in it to grow without any of that expense of tax associated with it. So if you, as Faye mentioned, maybe you have an ongoing business, and let's say it's worth $25 million. With a valuation, with some discounts, maybe we can get that down to 20 million or 18 million. So we've reduced some value on paper, and we either transfer, sell, we figure out how we want to put it into the trust. The trust now has it. You can have some benefit of that trust. Your family then has the benefit of that trust. That trust is out of your estate. So if that 25 million grows to 50 million, because it's not responsible for its own taxes, it can just grow and grow and grow. So if it grows to that 50 million at your death, that 50 million is out of your estate. So you're not paying 40% on that 50 million. Now you may say, all right, well, I like this idea of using up my estate through income tax as well each year. I'll do that. But what if I get to a point where I don't like that and I'm nervous about it, you know? We always put things into this type of trust. It's actually part of what we have to put into the trust that allows us to toggle it off. So I've had lots of clients who maybe started these, put businesses in when the businesses were just up and running. And so we could make a small gift. They pay the taxes on it, but then, you know, it goes for 25 years and they decide they're really done paying the taxes on it. So we can make a toggle switch essentially by utilizing one part of the trust to turn off the income taxes. So with these trusts, they are irrevocable, as Faye said. That said, there's lots of little twists and tricks that each trust is bespoke to its client. So the twists and the tricks that go into each of these types of trusts with toggles or with specific provisions for how to run the business that I just put into there, for when my children get it, if they ever get it, how do we want to keep it in that trust? So the intentionally defective grantor trust is a great example of what type of technique you're going to use between now and the sunset. And if we think it through, you have to take the time to say, okay, this is what I want to do. And we work with the attorneys and the advisors and we say, yes, this is what we want to do. Then the attorney is going to have to draft that. Then we have to get a valuation on the business because we want that. It's worth the cost because we're going to be able to depress the value on paper as far as IRS is concerned. And then once we have the valuation done, then we do the paperwork to get the asset into the trust. So you can see with multiple parties involved, multiple pieces moving at any time, there's some juggling that happens. So we're 15 months out now from the deadline. That's one way to think of it. And 15 months, when you add in all those steps, is not that long. It really is not. And as I think has been mentioned before, we're starting to hear from some valuation experts and some attorneys that they're booking up already. And so it really would behoove us to move and at least contact attorneys and accountants and planners to note that you're interested in this and would like to move forward with it. So again, this is one example of, there's lots of tools, lots and lots of tools we can use. Qualified personal residence trust. You have a vacation home. You're ready to somehow work it down to the children. That might be a good example. Charitable trusts. Again, you have zero basis stock. You can go ahead and give that now because the charity is not going to have a problem with this. So maybe that's where we want to plan to put that low basis stock. Grantor retained annuity trust. You need a little bit more coming back to you, So there's lots of ideas on up and down a ladder of how tight they are as far as irrevocable and how tight they are as far as how much you can benefit from them. But the intentionally defective grantor trust and all of its flavors and variations is just one of those ways to do it. And I think we have another polling question.
Yes. So another polling question here. How confident do you feel that you understand how your estate plan works, the taxes you will save, and how your beneficiaries will inherit? So we'll give you a minute or so to answer that question. We're getting some great questions in the Q&A section. Thank you for submitting those. We will try to answer as many as possible here towards the end of the presentation. If we actually don't get to your particular question, we will make sure we follow up with you with an answer. But one question that I will go ahead and answer right now, we had a question of, in that toolbox, what about special needs trusts? And special needs trust is definitely one of those assets, one of those specific particular types of trusts that can be used for estate planning, but then also assist with the goal of making sure that we have resources protected and available for a beneficiary who might have special needs. So yes, special needs trusts are definitely another one in the toolbox that we would be considering, in an appropriate circumstance. So results here, very confident, somewhat confident about, looks like the winner, about 43.3%. Some of you not confident at all. So, again, this question, what we're going to do now in our agenda is approach how maybe we can help you feel more confident and be sure that your goals are reached, and doing that in a tax efficient way. That I'm going to turn it back over. Oh no, we're going to talk about something here. Sorry, this is on me. How we can help you actually gain that confidence and feel comfortable that your plan is going to achieve your goals and protect the assets for your family. And how we can help you do that, first of all, is a goals conversation. What are your goals in terms of charitable, philanthropic, protecting assets for your family, anything else that you might want to accomplish during your own lifetime, and making sure that that plan takes all of those goals into account. Very important for business owners, your business succession or exit plan needs to be integrated with that estate plan. And it is very important for the business owners to think long and hard about this. If your business plan is an exit via a sale to an ESOP with management, or even a sale to third party or private equity, what does that do to my estate plan? What am I doing? What do I need to get from that exit plan in order to enjoy my retirement and make sure that those assets are available for my family after I'm gone? If you want your family to succeed to ownership of the business, how do we do that in the most tax efficient way making sure our management succession is in place, that the business is going to continue to thrive. With family, it's very important that, you know, family members understand what they may be receiving and how to handle that wealth, and helping you get your descendants and beneficiaries ready for that wealth. And then, of course, this is all wrapped in the umbrella of what we're talking about today. How can we do all of this in our most tax efficient manner, saving the taxes that, you know, saving as much taxes as we would like to? So now I'm going to turn it back over to Sheila to talk about ways we could help you with that.
Thanks. And I, as Troy mentioned, you know, we essentially want to take a really 360 holistic view. You know, a lot of people, a lot of clients will say, well, I've got a business, I've got my family, I've got my personal assets over here, I maybe have an inheritance over here, I've got stuff for my kids and grandkids over here. What we do is we take all of that, we look at it as one. We will take in a lot of data, we will reprocess all of that data, and we will put it into a format that's built to help you understand what you've got, where you want to go with what you've got, and how the best way to get there is. And we have a couple ways we work with folks to help them get there. Our first offering is a wealth transfer tax strategy blueprint. I like to think of this as, if you're going to build a house, you know what rooms you need to have, but you don't build them one room at a time. You make a blueprint of your house that you're going to build that's going to have these rooms. And that's what we do. We take that step back and we stop piecemealing things. That, oh, a life event happened, I did this. A life event happened, I did that. I thought about doing this, but I didn't do it. We step back, we say, what is everything you've got? We take a look at comprehensively everything that's out there. We integrate it into basically an action plan, a blueprint or a guidebook that will have action steps that will show you, if you do this, here's what it will do. In that, we cover cash flow forecasting. A lot of times we actually back into what we're going to do with the exemption through cash flow. You know, you need to know what you need to live on before you can decide what you're going to give away. We also look at, what is your succession planning for your business? Does the operating agreement provide for something that we have to abide by? Our ownership, is ownership tied to management? You have to be in the business to own. What sort of things do we work with there? We also look at protection, generation skipping, transfer tax. Some of that is very good protection. It keeps things in trust for future generations and avoids their creditors, their divorcing spouses. So it's a really good way sometimes to make sure that your wealth stays your wealth all the way down. We also, again, in all of this, we're going to weave into the blueprint your specific goals, your individual goals, how you're going to transition your estate from you down generations. Right now, we're in the largest transfer of wealth that the United States has ever had. And you may be part of that, either receiving it or giving it. What that does is it begets a lot of planning that needs to be done, because again, all of this wealth being transferred may be subject to a potentially 40% tax. What we end up doing with this blueprint is we'll come up with a blueprint. That blueprint will have an action plan. And it will basically, just like the architect gives you the blueprint, and then you go hire your general contractor, your subcontractor, all the subs. What we do is we take that blueprint and we do project management on building your estate plan house. We'll shepherd the team of attorneys and advisors. You know, sometimes it's really draining to have 5 advisors. These are good problems to have, but to have 5 advisors and you've got to constantly be on all of them. What if you just had a quarterback? You just had the general contractor and we're working out your subs. And we then also shepherd the timeline, so we know we're going to get finished in time. So essentially, this blueprint, you can think of it as taking what you currently have, where you currently are, figuring out where you want to go, and then making the plan to get there. Sometimes it's really hard to figure out where you are. That, especially if it's been 10 plus years or even 5 years, You may say, well, I've got these documents, but I'm not sure I exactly understand how they all work together now that I think about it. Perhaps you have an intentionally defective grantor trust and you were like, what? I didn't think it did that. We can help even there. If you don't even know where to start, we absolutely can help with that. And that we call sort of our exposure analysis or a mapping. And what we do there is we outline the status quo. This is what you have. This is what you've created. Here's how your plan would work right now. We would want to review the life events that led up to it and what life events you see in the future. We'd again still look at it from a holistic view of, does this meet your goals? And do you need to adjust your plan? But essentially, we can give you that simple and comprehensive overview that will have visual diagrams that show, here's what you've created, here's what it does, here's when it goes to folks, and here's who it goes to, and here's what you can expect for taxability and tax implications. With that, we'll typically also give you some specific observations, high-level ideas, and of course, offer to move this into, now that you know where this is, move this into a full strategy engagement where we can then say, let's architect out a full blueprint and let's get it done before 1/1/2026 so that we can take advantage of this extra space we have with the exemption. And a lot of times, again, if you have, let's say, some room to move several million that's going to go away on January 1st, 2026, there's really a lot of benefit to using this freebie money while we can. Troy, back to you.
Good points there, Sheila. I believe we have another polling question. We do. Would you like to be contacted by a Forvis Mazars Private Client professional to discuss today's topic, whether that be wealth strategy needs, tax needs, business succession needs? If you would like to be contacted about more than one of these areas, you certainly can just answer one question. And when we contact you, we can certainly help you and direct you regarding all questions that you might have. One thing that we've talked about today is the need to act quickly because of the time it takes to develop that blueprint that Sheila talked about, and then making sure that we get all other steps completed in terms of trust drafting, valuations, etc. So we're going to talk right now about what next steps should be, and we'll call an ideal timeline for getting those done in a timely manner to take advantage of the exemptions, and then we'll get back to some of your questions. But I keep saying you're gonna start us on.
Yeah. Thanks, Troy. So one thing, and there was one question in there I want to answer real quick because I think it impacts all of this. Somebody asked if the IRS was going to come back and claw back those gifts that have been made. So if we take advantage of, if you go and give away $13 million today, the exemption goes down to $7 million. Will the IRS come back and claw back that $6 million? The answer is no. They have actually released a statement that says they're not going to claw back. So that really allows us as planners to move forward with confidence on getting this done for the folks that it makes sense to do it for. So with that, we have this ideal timeline, and I would like to think of it as get it done as quickly as possible as it makes sense, because there are a couple reasons why I say that. One, there is no guarantee that Congress could not pass something sooner that would change these rules. We know we have these beneficial rules, the most beneficial we've had for years. So for people who it makes sense to do this planning, and we're talking about folks with taxable estates, so over that $13 million number individually, or over $27 million as a couple, if it makes sense for you to do this type of planning, and maybe even a little bit below that, depending upon some things, right? It makes sense to look at it now. There's not really a good reason to wait, especially because the sooner you do it, the sooner you'll get to take advantage of those freeze techniques, which will benefit the long term. So that's one reason. The other reason is that if some of these tools go away, we may not get to use the tool that we ideally would want to use that is available today. So for those reasons, I would say let's go ahead and get started as soon as possible. As Sheila mentioned, there are some accountants and attorneys, as well as the valuation experts, who are starting to book up over the next 475 days to get this all done. So we want to make sure that if you are someone who's a great candidate for this planning and it makes sense for you and your family, we want to make sure to be able to get all that done, because it's not just, call the attorney drafts some documents, you sign some papers. That's not there's more to it than that. If you own a business and you have stock, it might have to be recapitalized in order to give away non-voting stock for some trust reasons. We may need to move some things around on the balance sheet. We may want those things to cure for a few minutes before we move forward. But with that, we do need to get the advisors in place. That really is your first step, is calling someone like ourselves, or perhaps you've worked with a really sophisticated estate planning attorney before, working with those folks, get those folks in place now. So we are, we're not technically in fall yet, but I would go ahead and say that's right now. And then, as we look at your situation, talk through those goals, we're going to develop recommendations for you and your family. And so that's where we're going to put our own timeline together and action steps of what you personally would need to do to be able to complete the right plan for you. And then we're going to go into the execution. Hopefully by next summer. We don't want to be doing this at the last hour. Back in 2012, we had a cliff there that happened. And I know Sheila, Troy, and I we were all practicing law back then. And we were, I think, working all hours to get some of these transactions done. And, I think we all had a lot on our plates at that time. And so I think getting the folks involved that need to be involved now, the sooner we can get that done, the better for everybody, so that, comes holiday time, you can enjoy that time with family instead of worrying about whether a transaction is going to get done. So, yeah, with that, I'll turn it back over.
I was going to say, Sheila. One thing I would add to that is, on 13 million or 27 million, if you're a couple, I run into a lot folks who might say, well, no, I don't have that much, but they may be basing their valuation of their business on book value. And something that's really important to understand with estate tax is everything is fair market value. Fair market value is what would a willing buyer pay a willing seller. That's part of the reason we can get some discounts, because there's fewer willing buyers for certain things. So if you're not sure where you stand on the fair market value of your business, which can be more difficult, and again, why we need the valuation, I suggest call us anyway. It doesn't hurt to go through the exercise of working through what is the fair market value, and does that put you over the 13 if you're an individual, or 27 if you're married. So that's just another aspect of when we talk about what is your estate, it's kind of everything, and it includes businesses and non-marketable type securities at fair market value, not at book value or at any sort of basis level. So that's right. One thing that you may think you have 25, but you actually have 40 when you take into fair market value.
Right. And your life insurance very well could fall into that. So there's lots of things we need to think about here and really put together that, personal net worth statement.
All very good points. And one point I also wanted to make on this timeline is the point there at the very bottom. Review your plan on a regular basis going forward. I like to tell clients that helping them develop their wealth strategy plan is not a one and done deal. It's certainly necessary, and we're going to provide recommendations that are based upon your goals and how we think those can be achieved. in a most tax efficient manner today. But again, goals change, life changes, tax changes. So it's important. When I was still in private practice, I used to tell my clients, hey, here's this will and here's the revocable trust, and we got it funded and it's all done. Treat it like your car, but instead of every 3 months for an oil change, at least every 3 years, you're pulling that out, doing a review, and does my estate plan still do what it needs to do to achieve my goals? So again, it's a fluid process. It's important to get this part of it done to take advantage of these exemptions which are at levels that we've never seen before, but it's not you do it and you're done. We do still have to review it over time. So with that, we do have some time for some questions, and we've gotten a lot of them, and I appreciate all of you sending them in. One of the first questions that we got was the exemptions. We talked about the exemptions being 13.61 for an individual or 27.22 for a married couple. We had a question of whether those exemptions were affected if a married couple files separately. Does anyone on the panel want to jump in on that? Okay, I will. So it's different from the income tax system where you can choose to file jointly or choose to file separately. Making lifetime gifts, it is possible for one spouse to give more than their exemption and use the other spouse's part of the other spouse's exemption, or split them down the middle, if the spouses agree and sign on to each other's gift tax return that they're agreeing to those exemptions being split between the two. So it does work a little bit differently than say filing your 1040 jointly or separately, but it is possible for one spouse to use more than their own exemption and use some of their spouse's exemption if the spouse proactively signs the gift tax return to do that. There is also, and we had another question related to this, what is called now that I believe we got in the, was it 2001 tax law? I forget which tax act enacted portability, which means that if a spouse passes away and doesn't use all of their exemption at their death, then the spouse could pick up the remaining exemption and use it when they pass away, as long as the right 706 noting the portability is filed within 5 years of death. Then the spouse can use the unused exemption of the predeceased spouse. We had a question about that. The question was, will the unused lifetime exemption ported from one spouse to the other still be available to the surviving spouse in 2026, even though it might be higher than the new exemption? So one of my panelists want to weigh in on that question?
I'll take it. So the answer is yes. Now, there are some complications, and I've run into that. I've run into this actually. If the surviving spouse were to remarry, and then their second spouse predeceases and leaves them with less of a disuit, we can lose that. So it's definitely something we want to have a conversation about and just understand the ground rules on the specific situation, so that just you would know where you stand and what that all looks like for you.
Troy, I saw a question that I thought I'd take on whether there are any specific tax mitigation strategies for selling a business to help reduce capital gains. And one of the things that immediately occurred to me is, in parentheses, you had in the year of sale. There's lots of things we can do. The further between when we do them and the time of sale, the better. IRS looks for things that are done close together. So in the year of sale, yes. We love to get involved when you know you're going to sell. Maybe that's 5 years in advance, but that allows extra time to do even more things. Some of the things that I've worked with in the past are, there are states that don't have a capital gains tax. So between selling a business in, let's say, New York State, you're going to pay federal capital gains tax and you're going to pay state capital gains tax on the sale of that business. If that business was in a trust that was located in New Hampshire doesn't have a capital gains tax. So when that business that's owned by the trust in New Hampshire is sold, the capital gains in the New Hampshire trust are not taxed because there is no capital gains tax. So that's, it could be Nevada, it could be Tennessee, it could be Texas, places that don't have an income tax. There's ways to put businesses in trusts that live in that state without you having to live there. That gives them a protection from state capital gains taxes. I've worked with clients who, on an annual basis, on $1 billion business, might have saved $250,000 of annual income tax capital gains savings. And then on the sale of the ultimate business in about 10 years, they'll save millions and millions on state capital gains taxes. So that's, there's always ways to try to find the best place to put these trusts and vehicles as well, because there's jurisdictions that want this business. So there's a lot of trust-friendly jurisdictions that say, hey, we're great for business, we're great for tax, we're great for trusts. And those states, have case law, they have statutory law. In Nevada, there is a Supreme Court case on domestic asset protection trusts. So right now, that's a really great place to do creditor protection. That can go hand in hand with selling a business. And a lot of people choose Nevada because they've got a Supreme Court case on it. So with regard to specific mitigation strategies, there are a lot. We always talk in terms of mitigating or minimizing or reducing. It's pretty hard to eliminate altogether, but we work towards it.
Thank you, Sheila. Hey, we had a good question here, and I'm going to go back several slides that it relates to, if I can find them quickly. Sorry. This slide right here. We had a question of, is the 7 million plus exclusion that we are showing for 2026 here, is that an estimated value or is it a certain value? And we had a discussion about this yesterday because of some publication. Faye, do you want to take that question since we talked about it yesterday?
Yes, absolutely. And so this is very much estimated. So the way that they calculate what the exact number is, right now we have 13.61 million available to each person. That's a pretty random number when you look at it. So it's not someone picking it out of a book. What started as $5 million has been adjusted for inflation. And then, up here, as they change the law, there are inflation adjustments that happen every single year. So yesterday we got an estimate of what next year's inflation number is going to be. So we expect that next year in 2025, now this is not official yet, but this is based on some Bureau of Labor Statistics numbers. And so that would be $13.99 million is what we expect. 13.99 million is what we expect the individual number to go up to. And we do expect the amount you're going to be able to gift to each individual person without having to report or deal with any complication at $19,000 per person. So that is what we expect. So that 2026 number is very much an estimate because if there is a sunset, if the sunset happens, so if Congress does not act before January 1st of 2026, the law automatically reverts back to the $5 million number plus inflation. And so we don't know exactly what that number will be. that's where we use general estimates. It'll be, the guess is somewhere in that $7 million range, but it will depend on inflation adjustments that they will go back and calculate. So we will not know that number until next year. And if it even, if it happens, right? So that's where, we don't even know who's going to be in Congress next year. So it's hard to predict. I know folks would love to know what's going to happen. But it is tough for us to be able to predict those things as of now. But we will be watching it closely and keeping up with it.
Great, thank you, Faye. We had one more question I'm going to answer real quickly, and then for anybody that did ask a question, again, we'll make sure to follow up with you after the exemption. But we had a question here that said the married couple could transfer 27.22. Should they implement a gifting strategy prior to 2026? And we had a question of what exactly the definition of implementation is here. And what that means is that the gifts using the exemption, so the wealth transfers or gifts to trust or however you decide to use your exemption, are completed by December 31, 2025. That is implementation. So with that, I want to thank all of my colleagues today for helping with us. I really appreciate all of you attending. If you do have questions that you didn't get into the chat that you would like to ask, here are our names and contact information. If you can jot that down, we'd be happy to help answer your question. And again, if you did put one in chat, we will be following up with you. Again, we really appreciate your time today, and thank you very much.